is Lorelia, and welcome to another episode of the Never Lose a Deal podcast. This is the podcast that you want to tune into if you are a real estate investor who desires to have more funding opportunities outside of the norm of what's in the marketplace. So, my name is Lorelia, and I am not new to the conversation of financing and funding when it comes to real estate. And so, if you're watching me on YouTube right now, here on YouTube, I have over 800 videos on this subject matter. So, understand that I'm not new to the conversation. And if you're listening to one of the podcast streaming apps, I suggest you head on over to YouTube to check in and listen to some of my previous content where I discuss a lot about financing and funding. And so today I am coming to you to discuss understanding private lending and creating your real estate yields. And so this podcast is going to be a little different than what I usually do because I will be sharing my screen. So if you are listening on Shopify, I mean, not Shopify, Spotify, you will be able to see the video version of this podcast and, of course, on YouTube. But I know on the other streaming apps, you'll only get the audio version. So you're going to have to hop on those other streaming and YouTube um platforms to be able to see my screen because I will be sharing my screen. So why am I discussing understanding private lending? Well, currently right now, as I film, or should I say do this podcast, we are now in the month of July. It's 2024. And so just about early July, July the 10th, I kicked off a workshop, virtual workshop that I'm doing called the Raising Capital Summer Accelerator. And so what I have is that I am working with some serious real estate investors who want to expand their funding toolbox outside of the norm of what people are used to. And so during this workshop, it's a 4-week workshop. We meet every other week. So it's going to go from July until August. And like I said, July 10th was our first meeting, and next week will be our second meeting, which would be July the 24th. And so, as I said, I'm doing this workshop to expand and be able to share other ways that real estate investors can fund their deals. Part of the framework that when I work with clients, I share with them what is called a business funding capital stack. Right now on the internet, there is a bubble when it comes to funding. So you have a lot of people who have misled people to have people to think that, funding or business funding is just business credit cards, um, and maybe lines of credit. And although that's a good place to start, as you move up and do a few things in real estate, um, credit cards and lines of credit as well as loans are going to be at a particular capacity. And then, you're going to have to look for other ways to be able to finance what it is that you do. Now, of course, part of that capital stack is I talk about asset-based loans. So, of course, for the investor who wants to invest in multifamily properties, DSCR loans would be a choice that they would look at. And so, of course, that would be part of the funding capital stack. But an area that's really untapped, and that is what I'm going to talk about today, is private lending. And so I'm going to be sharing my screen. So that's why I said, depending on how you are viewing this podcast, like I said, if you want to see my visuals, you have to go to Spotify, or you have to come to YouTube to see my screen. And so I want to share my screen, and I want to go to the definition of what what a private lender is. So I'm going to share my screen. And so if you type into Google, what is a private lender? According to this AI search, it says it's a private lender is an individual, organization, or group that lends money outside of the traditional financial services industry. Private lenders can fund a variety of loans, including real estate, personal, education, and business loans. And they are not affiliated with a financial institution. So there you have it, ladies and gentlemen. That is who a private lender is. So a lot of times, depending on the exposure or the knowledge base of a real estate investor, they may think a private lender is a hard money lender. And as you can see with that definition, um, 90% of hard money lenders are, they consider themselves some type of legal entity or a institution. Well, private lending is a person just like me and you. That's right, me and you. It can just be a person who has funds set aside, whether it's in their retirement account, whether it's in their business bank account, whether it's in their personal account, that they want to be able to put those funds to work. And that is why I wanted to be able to share with you today a case study. And now that I'm thinking, I should have probably titled this the case study, but I'm going to share with you a case study so you can get an idea of what it looks like um, when a person lends you money. And I'm going to use myself as an example, some of the scenarios of how I've been able to help a private lender earn money on their money. Because at the end of the day, who doesn't want to have their money put to work? And so, like I said, not to make this into a teaching session, but when it comes to private lending, there is a lot of mindset hurdles that one may face. Like some people may not have to face those mindset hurdles because they totally get it. Hey, I got money sitting to the side. I'm not getting anything on a savings account. I'm not getting anything on a CD. Right now is invested into stocks, and right now the market is a little topsy turvy, and I kind of want my money to still earn money on the money, but it's being protected with a hard asset, which is real estate. So, like I said, for that person who doesn't have those mindset hurdles, they totally get it. They're like, it's a no brainer. My money is protected because there is a hard asset that is the collateral for my money. In the event anything goes sour, of course, they're going to have their attorney to make sure all the paperwork is drafted to protect them. And if it works out well, of course, they're earning money on their money. So what I'm going to do is I'm going to share my screen because, like I said, these are the topics that I am discussing, and I'm going to be going over in the next 4 weeks to be able to share with those investors who've taken the opportunity to be part of this workshop to look for ways that they can partner with private lenders to fund their deals. Because what a lot of people don't know, that when it comes to just self-directed IRAs, and a lot of private lenders do use self-directed IRAs to be able to fund these deals. What a lot of individuals don't know, as well as real estate investors, is that there's over $12 trillion sitting in self-directed IRAs as of, I think, last time I did the search. I don't have it up now. So, but if you Google it, I think of as of 2021, 12 trillion. So what that means is there are investors who totally get it. They want to be able to control how they invest their retirement funds. And so, of course, self-directed IRAs can go into a few asset classes, but real estate is one. So when I talk about private lenders, understand these individuals, they get it. They're not individuals that you got to educate, you got to teach, because a lot of times when it comes to private lending, and once again, the mindset hurdles, a lot of people start to think, oh, you're trying to raise money to for a fund. No, that's not what it is. Because private lending, yes, you are raising capital, but no, that's not what this is. We're not raising money for no fund. We're not raising money for some type of syndication. We're not raising money to put into a REIT. What you are doing is partnering with a private lender. It can be an individual, it may be a husband and wife, it could be partners where they totally understand the lending relationship. Because, like I said, they want their money to make money, and they also understand real estate. They know their money is protected with a hard asset, which is collateralized by the real estate. So as I mentioned to you, I'm going to show my screen to give you an idea of what it looks like for someone like myself. So like I said, for those who are listening, Lorelia is sharing her screen. So if you want to see what I have here, like I said, you're going to have to head over to Spotify, or you're going to have to head on over to YouTube. So kind of wanted to make this a little bigger. So once again, I wonder if I can do the slideshow. I pray that this works. But anyway, this is a particular home in Louisiana. I mean, not Louisiana, Mississippi. Is Bay St. Louis, Mississippi. And so, like I said, this is a case study for myself. So, someone like myself, I invest in mortgage notes, non-performing, particularly first position liens. So what that means is that there is a person who owns this home, but they are making payments to the bank. Well, prior to me getting involved in this particular transaction, yes, there was an entity they were paying. They were paying a hedge fund that they thought was the bank. Well, that hedge fund decided to sell some of their assets, which are the non-performing mortgage loans, mortgage notes particularly, but for those who don't know, mortgage loans. So of course, this house is collateralized. The note is being collateralized to the house, or vice versa, for you all to understand. So what that means is that the hedge fund decided to sell some of those mortgage notes. And I raised my hand and I said, hey, I'm interested in buying some of these mortgage notes. Now, of course, could I use my own money? Yes, I could. But of course, when it comes to leverage and it comes to real estate, what about me doing OPM? Other people's money, leveraging other people's money. Well, why would a person want to give you money, Lorelia? Because they understand that they want their money to make money. Remember, I said the 12 trillion self-directed IRA investors? Like I said, those investors get it. They don't need to understand how real estate works, particularly the ones who do use real estate as an asset class for their self-directed IRAs. They don't have to convince, you don't have to convince them. They totally get it. Now they're just looking for opportunities that is a win-win for the both of us. And so that is what I did. I created a win-win for a private lender. And so I'm going to share with you what the numbers look like. So in this particular case study, as I said, the home is in Bay St. Louis, Mississippi. It's a non-performing mortgage loan. These are the details. Now, this is what the information that a hedge fund will provide to me for me to decide if it is a win for me to want to move forward and bid on a mortgage loan. The fair market value of that particular home was about 105,000. The UPB, for those who don't know, is the unpaid balance, which was $48,967. That is what the bank, or should I say more hedge fund, would like to sell this particular mortgage note for. That's what they would like to get. The payment for this particular mortgage loan was $559.37. The bid price, that is what I bid it on, and I'm going to go into that in a minute, was $33,091.86. My yield on this was 18%, and it had a cash on cash return on investment for at least for the year one at 20%. Okay, Lorel, you spit off a lot of numbers. What does this mean? Why would a private lender want to lend you money? Well, once again, remember, if an individual wants to earn money on their money, I'm positioning this. This is called understand the economics of a real estate transaction so it can be a win-win for myself and for the person who I would like to leverage their money, which is, remember, the OPM. There's a lot of people on the internet that's talking OPM, leverage other people's money. But the part that they never show you all is they never share with you all the economics of a real estate transaction. Most people on the internet is not giving you context. So all you know is that OPM. You know the word, you may know the definition, you may know how to be able to explain it, but you don't know the economics behind it. And so what happens is that now you're in a state of confusion. And so that is why the investors that have decided to raise their hand and partner with me so they can attend my live 4-week class so they can learn how they can have economic conversations with a private lender. Most people, when it comes to financing, when it comes to funding, raising capital is just, for how I teach my clients, it's just another funding vehicle in your funding toolbox, because I'm not a one-trick pony. And so what I tell my clients, you do not want to be a one-trick pony. So many of your funding gurus, they only have one trick, and their trick is really a credit card. And really, to be honest with you, and that's, I don't want to go beyond the scope of this video, but nobody starts investing in real estate with a credit card. Oh, well, Aurelia, you've been talking about business credit funding since 2018. Yes, but I have never talked about it as a place of it being its primary source for you to get real estate. But of course, that's not the topic of today. So going back to the economics of the deal, the yield is 18%. What does that mean? Well, that is the interest that the investor, the private lender, is going to earn on their money. Ladies and gentlemen, tell me, what investment do you know out there in the marketplace that is going to give you an 18% return? That's right, I'll wait. It doesn't exist. You're not going to get it from your savings account, your annuity, your life insurance policy, your CD, and maybe not even your stocks. Now, one may say, hey, Lorelia, you can get them type of returns under some type of volatile asset class, like maybe crypto, Forex, whatever. But remember, I said before, why this could be a safe asset for a safe investment for an investor, because it is backed and collateralized by real estate. If all else fails and this investor does not get their 18%, they can always move forward and foreclose on the particular home, go through all the necessary steps that they need to go through legally to get their money back, because they invested in this particular asset because it was backed by real estate, and they're looking to earn money on this investment. So the 559 is what the actual homeowner who lives in that house is going to pay. But remember, I said about the UPB of $48,967. Well, once again, me as a person who's bidding, I'm not going to give the hedge fund the actual $48,000. Why would I want to pay par on a mortgage note? No, I want a discount. So my discount, which is my bid price, is going to be $33,091.86. See, when I pay that price, that allows me to get the yield of 18%. So now, of course, since I'm not using my own money and I'm working with an investor, they're going to get half of that yield at 9%. 9% is still a good deal because we have interest rates that are at 7%. So the fact that they are lending money out, they're getting a return of 9%. It's backed by real estate, meaning a hard asset is collateralized against their money. They're in the winning seat as a lender. This is an example, ladies and gentlemen, of what I mean when I say being the bank and also being protected. You're not going to get these returns from no CD, as I mentioned, no savings account, no life insurance policy, and of course, the list goes on. Not even a stock account with the way the market is working right now. So this is why a private lender would want to partner and lend on deals like this, because remember I said the 12 trillion that's sitting in the self-directed IRAs from custodians all across the country, because they're all different types of custodians. It's not just one. They get it. This is how the wealthy continues to stay wealthy, because they put their money to work. They're lending out money and they're earning money, the interest, which is called a yield. So this is a case study, an example of how I have been able to do this with the private lenders that I work with. This is how that goes, ladies and gentlemen, because I always say there's 100 ways to skin a cat. Now, many people are going to watch this video and they're not going to have no idea of what I'm talking about because they have not been exposed to this concept. And then also, they don't even realize that investing in real estate mortgage notes is possible. But this is not a video on real estate mortgage notes. This is a video on private lending, because remember I said I wanted to use myself as an example so I can share with you and show you what does it look like. Why would someone want to lend their money out? Because remember I said there's mindset hurdles that some people are going to have to get over. And they're not going to understand why people lend their money out. Well, the people who understand that they would like to be in the lender's seat and get 9% interest, rates are at 7%. So your leading institutions are loaning out money, as well as the non institutions, those who do alternative lending like DSCR loans and commercial loans or what have you. The only lenders that I can think of that's probably getting double-digit returns are probably hard money. And of course, we know hard money is short-term money. A lot of times it's no more than about 12 to 18 months. But outside of that, for the 30 years, And the only thing I didn't put on there was a term. So that it's 200 more payments that's remaining on that particular asset. And of course, a private lender would not have to be in it that long because, of course, these are some of the things that I would be able to negotiate with the private lender. How long would they like to put their money to work? How long would they like to be in it? And in a particular scenario like this, I always suggest about 24 months, 2 years. So let's just do the math on that. The 559, the 559 times 12 months is 6,000. Let me make sure that's right. Yep, $6,708. That's with the whole payment. But of course, working with the private lender, they're going to get half because we're splitting it. So they're going to get half of that, which is $3,354. This is passively. This is money that this mailbox money that they're going to get, that they don't have to work for. Now, I know one may say, well, Lori, that's not really impressive, $3,000 a year. Well, this is passively. Let's take that if they were doing this with 10 other mortgage notes. It's 33,000 that they would be getting a year passively, where they're hitting both areas. They're putting their money to work. They're getting interest rate yields higher than 7%. And then, of course, this particular investment is secured by a hard asset, which is real estate. This is why when I say private lenders, these are everyday individuals. But these everyday individuals, they understand the conversation of real estate. They understand the conversation of putting their money to work. Now, your job as an investor is to get in front of them and to explain the economics of what it is you do. Because most people, they enter this space from a place of desperation. I need. I've saw it for pretty much for 4 years, especially when the whole business funding, business credit kind of taken off. You had a bunch of desperate individuals on the internet talking about what they need, what they need. And my thing is this: there's no shortage of money, there's no shortage of income. But when it comes to things like this, what it is a shortage of are people who know who can actually analytically communicate what is a win for that person. Because most people come from the place of how does this work for them? But they never go to a place of how does it work for this person? What's the win-win for them? And that, ladies and gentlemen, is why I titled this podcast episode, Understand Private Lending and Calculating Your Yields. Like I said, I should have called it case study. But this is an example. And this is what I'm going to be doing. Like I said, this what I shared with that today is just really just the surface of what we really are going. Because like I said, it's 4 weeks and it's so much that I can unpack with individuals. But like I said, this video is a podcast episode is really just to give you a surface idea of how this works. Because most people can give you a lot of content. They can look at something online. They can't give you no context of how it would work in real life. So if you are somebody who may be interested in the Raising Capital Summer Accelerator, like I said, we've kicked off since July. I have to tell you, the cohort is closed. So I'm not looking to bring in any more people in this particular cohort because we've already taken off. But what I will say for those who are interested, because I've had a few people, at least on my email communication list, who've raised their hand and they're saying, I would like to learn this information too. How can I learn it? And I've said to them, well, you can have access to the replays. They are for sale. So what I will be doing is, yes, this is my commercial for the podcast. I am reselling the sessions every week. So if you're on my email communication list, the week one is going to be an email was sent out on how you can move forward and purchase it. Like I said in week one, and of course, if you're on my email communication list, I go through all of what is entailed in what we talked about in week one. And then, like I said, week two, we kick off next Wednesday on July 24th. And once again, that is another area we're going to be touching into. So if you want details on that, like I said, access to the class is not available right now because we've already started the cohort, but I am reselling the actual sessions while it's going on. I'll be selling one by one, but at the end of the whole thing, I will be selling the whole 4-week session for you to have. And understand, I'm sharing everything. I'm sharing contracts. I'm sharing marketing pieces. I'm doing everything, the economics of a deal that is necessary for you to, like I said, expand your funding toolbox, because there's 100 ways to skin a cat. When I talk about funding, and like I said, when I share with clients the funding capital stack, it consists of many areas. It's not a one trick thing. Most people, like I said, they only got one trick, and that's probably credit cards and lines of credit. And a lot of times that ain't even what it is that they're doing. Um, because that's why a lot of people out here in the marketplace, they got the credit cards, but they haven't been able to move over to the real estate, because really what they were sold was glorified credit repair. So once again, this is Lorelia. Like I said, if you are listening on the podcast platforms, you may not see what I share, but if you want to see the actual visuals of me sharing my screen, go over to Spotify, or you can go to the platform YouTube. At least on YouTube, you can see the 800 plus videos that I have there on this particular topic. Like I said, Never Lose a Deal is all about the creative ways that you can fund and finance a deal, because you don't want to lose out on it. If you have different funding and financing tools that are part of your funding toolbox, you can win. So once again, this is Lorelia. See you in the next episode. Like I said, you want to know more about the Raising Capital Summer Accelerator, get on my email communication list, and I'm at www.neverloseadeal.com.